Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the trading day. Let's get to the three market catalysts we're watching this hour. First up, we bring you the latest trade headlines from Washington and unpack the effect it could have on your portfolio. Plus, a preview of this week's inflation report and what the economic data means for the Fed's interest rate path. And Bitcoin's rally powers on as the digital currency tops $123,000. We'll discuss that and much more on Market Catalysts. Let's get a check of the markets first here. We see a little bit of a downdraft here today, but the markets continue to avoid sort of a worse impact from most of this trade headline risk here, even as we hear President Trump threatening 30% tariffs, for example, on the EU, 35% tariffs on Canada. We've got the Dow right now only down about 0.1%. That's less than 50 points. The S&P 500 down not even 0.25%. The S&P down about 1/5%. And let's check on the bond market as well to see where yields are going. There too, very little change. The 10-year stands at 4.41%. Well, an EU trade chief warning to Monday that President Trump's 30% tariff threat on the EU is effectively prohibitive to trade between the two nations, adding that the new rate could warrant retaliation from the bloc. EU and U.S. officials are set to speak Monday after President Trump released letters over the weekend unveiling a new tariff rate set to go into effect on August 1st. Joining me now, Tim Urbanowitz, Innovator Capital Management Chief Investment Strategist, our Washington correspondent Ben Worskell, and senior legal reporter Alexis Keenan. Ben, let's start with you. Tell us the latest here with some of these new numbers being thrown out there.
For sure. Yeah, I think a good rule of thumb maybe for investors is that when a deadline is still a few weeks away, that's kind of one of the peak headline risk times. And so I think we're seeing a lot of that. That's a lot of what's going on here in all this back and forth over the weekend and this morning. And we're seeing it from both sides. And this obviously comes after Trump's surprise announcement of 30% tariffs on the European Union. Even as negotiators continue to talk. It's worth noting also that other comments this morning from the European Trade Commissioner, these came in a bunch of comments to reporters, were more optimistic that talks are going to continue. And he said, quote, he sensed they are approaching, quote, a good outcome for both sides. So there is still, that sort of points to me to the overall landscape here with Europe, which is that there is the parameters of a deal. They're getting closer. They clearly came up short last week, ending with this 30% letter, but there's still a sense of progress there and just sort of refocused on an August 1st deadline. From the White House side, we're kind of seeing a similar dynamic. We're seeing kind of a bluster from Trump. His comment this morning was that more broadly was that nations should sort of be happy with his letters coming out and should be sort of acknowledge that they ripped off the U.S. I'm pretty skeptical that any country is going to take that too seriously, but we're seeing a lot of signs from Trump's aides that this is essentially a negotiating play. Kevin Hassett was telling reporters this morning at the White House that, yes, negotiations are going to keep going with Europe, with Canada, with Mexico, which are two other major recipients of these kind of surprise letters we've seen in the last couple days.
And Tim, I want to bring you into this. Is this why we're not seeing markets react more? Because again, you know, participants are not necessarily taking it seriously that these are actually going to go into effect?
Well, Julie, I think investors need to take the president serious on this. Yes, there will be negotiations. We think those negotiations are going to take a lot longer than is currently priced in right now. They're not going to be easy. But at the end of the day, the destination is higher tariffs. And I don't think investors have digested that yet. The destination is higher tariffs. You look at what the president wants to accomplish with these tariffs. He wants to close those trade deficits, okay? That's big. The only way you possibly do that is to weaken the dollar. So that's a big component of this. We need to be paying attention to that. And he wants to bring manufacturing back to the U.S. How do you do that? You have to make the cost of producing goods overseas more expensive. So for investors, there's a lot of implications. All signs on our front point to higher inflation.
Ben, and I want to bring you back into this because to the point that Tim was just making, I was looking at some of the latest numbers from the budget lab at Yale University, which I know all of us have been tracking because they are sort of keeping track of the tariffs and the effect. They said the effective U.S. tariff rate under President Trump has risen to 16.6% from 2.5%. And if all of these tariffs he's now talked about go into effect, it would be 20.6% on August 1st. You just heard what Tim was saying here. Yeah. And it is interesting to try and read between the lines as to what all the advisors are saying. But, what's the sort of takeaway as to how realistic it is?
Yeah, I mean, I think the takeaway, I think Tim's exactly right that there's a reason to be skeptical of these top level lines, but I'd also think the end is a higher tariff level. So somewhere between those two budget lab numbers is probably where this ends up on August 2nd once these are in effect. The sort of taco trade idea that Trump always back chickens out is true to a certain extent, but he does follow through on some of his promises. So say he backs away on Canada for a little bit, but goes forward on Mexico. There's all these different factors here, but I do think it's right that the bottom line here is that tariffs are rising to some extent. The question is how much. As Trump is supremely focused, as Tim also mentioned, on this revenue question. The president really wants revenues to be a huge component of the budget going forward. It's growing at incredible paces. It's still got a long ways to go, and you'd have to raise tariffs a lot more to accomplish those goals.
So, Tim, if you're looking at all of the repercussions of all of this, I mean, what do you need to keep an eye on in your portfolio?
Well, I think you have to focus on how do you inflation-proof the portfolio at this point. It's so important. We look at tariffs, this trend toward deglobalization. I mean, the global economy is changing before our eyes. Now, this might take longer to play out, but you're going from a point where you had countries that were producing what they were good at, they could do cost effectively, to now that's breaking down, right? So that, in our view, points to higher inflation. We look at other things like the big beautiful bill, all point to the same thing. So a couple things we're talking about with investors right now that we think are really important. One is finding ways to increase the equity exposure that you have. If it was a 60-40, how do we get that to a 70-30? We think that's very important. Companies can still thrive in this environment. This is not 2022 where we see inflation going to 9-10% again, but it's just staying sticky on that 3.5% level. So that's one thing. And then also just looking for stores of value, increasing the alternatives bucket as well. Things like Bitcoin, which is making new all-time highs again today. We continue to have conversations with advisors about how to get that and incorporate that into the portfolio, because if you look at the fiscal picture, it's not pretty, and we think it really points to reduced purchasing power for consumers.
Put a pin in the Bitcoin conversation because we're going to come back to that later, but I want to dig into what you're saying about equities a little bit more here. Increasing equity exposure. What does that look like, especially given, again, this risk out there that it looks like undoubtedly we're looking at a higher tariff rate. It's just a question of how much higher. But given that, what does that increased equity exposure look like?
Well, we still think companies can thrive in this environment. And the way that we're viewing it, you look at equities, you look at bonds. You buy a bond, you're subject to whatever coupon payment is being dished out, the yield that you purchase at. You don't have the ability to increase. Okay, with stocks, these companies have the ability to pass through higher cost to their customers. And especially now when we look at this in the context of all the potential tailwinds coming from the excess spending from Washington, the big beautiful bill, the tax cuts, that's going to be a tailwind for consumers. So companies, in our view, are going to have the ability to pass these higher costs on to their customers, which as a shareholder helps protect you. So that is why we think that is so important right now. Obviously, there's different pockets that we think can do better. Those companies that have higher pricing power, more inelastic demand, higher margins, we think those companies can do very, very well right now. But at the end of the day, how do we reduce fixed income, which is going to be more susceptible to sticky inflation, and increasing equity exposure critical right now?
There is another angle on the tariff situation that we have to talk about, and that's the legal angle. For that, we turn to Alexis, because with that tariff deadline now set for August 1st, there are two challenges actually set for arguments in some of the cases here in two appeals courts on July 31st and September 30th. So, Alexis, what do we know about this, and what should we be following?
Yeah, so to Tim's point, take those tariffs seriously, because that's what the lawyers are saying too. So I've been talking to trade attorneys to ask them if these two court decisions, or court arguments, I should say, eventually decisions, one is set for the end of July, the other set for the end of September to get those arguments going. I've been asking them if those cases could potentially end or put on hold those particular tariffs that are in place right now, or tariffs in the future. And really they say, well, the law at issue is so narrow that it's not likely to end kind of the way that the wheels have been turning. Now, you have even if the Trump administration were to have lost those on appeal, they say you have that narrow issue, one IEPA, that International Economic Emergency Powers Act being looked at. It's too narrow to answer really broader questions about presidential authority. You have other laws that would also allow, that carve out presidential authority to tariff. Some of them, Julie, require investigations by the administration. Those can take up to 1 to 2 years. And some of them are a similar kind of unilateral authority for the president. Some of them tested, some of them not tested. So the point here from the lawyers is these alternate attempts by the administration, they could be taking up court time, additional court time, in addition to the cases that are before the appeals courts right now. And on top of that, you just have potential for these issues to reach the Supreme Court, certainly, but they're not necessarily issues that these lawyers think that the Supreme Court would expedite, and therefore we might not be getting any answers anytime soon. The message here largely from these lawyers is that businesses, that import-export partners, that they should not be really changing the calculus at this point based on these court decisions.
So yet something else to weigh in terms of the uncertainty around all of this. Alexis, Ben, thank you so much. Tim's going to stick around. Coming up, it's a busy week ahead for economic data and Fed speak. We'll have more on what to expect and how to trade it when Market Catalyst comes back. It is a busy week on the data front. Investors expect Tuesday's CPI reading will show inflation accelerated in June as President Trump's tariffs take effect on consumer prices. The data coming amid growing tensions between the Trump administration and Fed Chair Jay Powell. Joining me now, John Hilsenrath, StoneX Senior Advisor, Gus Fauché, PNC Financial Services Group Chief Economist, Tim Urbanowitz, still with me, Innovator Capital Management Chief Investment Strategist. Guys, thank you all for being here. Gus, I want to start with you and just get your expectations for where you think this number is going to come in. I believe consensus is for month over month, both core and headline to be to show an increase of 0.3%. Where are your forecasts?
That's right. We're right at 0.3% for both the headline CPI and the core CPI, excluding food and energy prices. We expect to see both of those accelerate on a year-over-year basis as well, so slightly higher inflation. We are going to start seeing the impact of tariffs on inflation over the next few months. We didn't see much of that in May. I think we'll see some of it in June. We'll see more of that in July. And that's going to make things more difficult for the Federal Reserve. They have to figure out how much of this is temporary, whether it's going to cause permanently higher inflation, in which case they may need to respond.
And is there any way, Gus, of sort of sussing out how much of the increase is related to tariffs?
What we'll be looking at is the various components of goods inflation in particular. Obviously, tariffs are a tax on goods. They're going to lead to higher goods prices. So we'll be looking at which categories saw an acceleration in inflation. Is that a category where there tend to be a lot of imports? And so that's raising prices, not just for foreign manufacturers, but also domestic manufacturers may take advantage of that to raise their prices as well. So we're going to be looking very closely at exactly where the acceleration in inflation is coming from to determine whether it is indeed tariff driven.
John, I want to bring you into this because you, of course, wrote about the Federal Reserve for many years at the Wall Street Journal. There is a new report this morning out of Axios that the administration has asked the Fed's Inspector General to review its big renovation plans. They're renovating the building that the Fed is in. And this is being seen as yet another way to sort of put pressure on Jay Powell. How are you reading that whole situation?
I think you're exactly right. It's another way to put pressure on Jay Powell. And it reminds me a little bit of the battles or the dynamic that we saw between Richard Nixon and Arthur Burns back in the 1970s. There was a story that came out years later where the Nixon administration put out stories about Arthur Burns asking for a personal pay raise when he was also putting pressure on the administration to impose wage and price controls. It turned out to be a false story, but it was the Nixon administration pressuring Burns to go its way on interest rates. And I think that's where we're going with the Fed right now. Just a lot more gamesmanship with the White House. Now, What I'm saying isn't to excuse any cost overruns that might be happening at the Fed on this renovation, which is, I mean, a real event. But it's just an issue that's become politicized. And frankly, I think it's going to be a bigger problem for the next Fed chairman than it is for the current Fed chairman. Powell has dug in his heels. He said he's not going to be bullied by the White House, but the president is going to be picking a new chairman over the next few months. And that person is going to have to deal with a White House that wants lower interest rates in a time of higher inflation. And it's a real challenge. And frankly, I don't think the markets have fully woken up to the political dynamics here.
Not for nothing. I have never met a renovation that did not go over cost, John, at least on a personal basis.
Right, but here's Warren, $2.5 billion. I'm hoping.
No, if only. If I would not, I don't think I would be here if that were the case, John, to be fair. But I want to bring in the other guys to talk a little bit more about what you just mentioned. And Tim, why don't you come in on this about whether the market is really focused on this right now and incorporating the idea of this sort of power struggle effectively between the White House and the Fed?
Well, they should be. And I think a lot is going to change next year. And to John's point, you know, it may be an issue, but this is not about inflation in our view. This is not about the renovations. At the end of the day, we think this is about the fiscal situation. You know, we've gone from about $500 billion in interest payments pre-pandemic to 1.1 trillion today, with an average rate right around that 3.3%. So, you know, the Treasury, they need to get interest rates down to make this picture more sustainable. And I think that is why you're seeing such tremendous pressure from the Trump administration on Powell. We take a step back, we think the Fed is in a great spot here. They have the ability to pivot if the data starts to deteriorate and cut rates. They have the ability to hold firm if we see inflation firm. So we don't think it's about any of that. We think it's really about the fiscal picture. And investors need to be paying attention to what that means. And we do think if you have a situation where the Fed does turn around and cut rates prematurely, you are going to see the long end of the yield curve tick up, like we saw last fall. We think that's going to happen again. So you may see shorter term interest rates come down, but even if the Fed cuts, we don't think that's bringing the longer end of the yield curve down.
I mean, Gus, what do you think of all of this? From what Tim is talking about, that the real issue here is payments, the U.S.'s interest rate payments. Is that the Fed's problem?
It's not supposed to be the Fed's problem. The Fed has a dual mandate of maximum employment and stable prices, which they've defined as inflation of 2%. It's supposed to be Congress. It's supposed to be the administration to address fiscal concerns. And I think Chair Powell has made it clear that that's not part of his mandate. The Trump administration, when they appoint a new Fed chair, may want to get one who will address that. But then you still have to deal with the other members of the Board of Governors, the regional presidents who are on the Federal Open Market Committee meeting. And I think it could be a very ugly situation if the administration tries to push too hard to bring down rates in order to support larger budget deficits.
Yeah, but paint that picture a little bit more for us, Gus. What does an ugly situation look like? What are the ramifications there?
You have a lot of dissents. You have members on the Board of Governors itself dissenting against the chair, which is unheard of. You have regional presidents who are voting no regularly. There's just going to be a lot of confusion in monetary policy. It's going to be very, very unclear where it's going. It's going to make the process much more difficult. And I think that this could lead to a lot of volatility in financial markets, and it could lead to higher inflation if the Fed is cutting for the wrong reasons because they're trying to support the administration with large budget deficits.
John, I want to come back to you finally on the so-called battle of the Kevins, right? That the Wall Street Journal had reported on, that Kevin Hassett, Kevin Warsh are the two that might be in the most contention here. But, both of them, particularly Hassett, is certainly seen as sort of a patsy of the administration, right? So what are you hearing, and what are the sort of risks of choosing one of these guys?
Well, I mean, this is what I was referring to a moment ago, is the president is going to be picking Powell's successor over the next few months. And he's made clear that he wants someone who's going to be committed to lowering interest rates. And this is where I want to connect back to what Gus and Tim said. I agree completely with what Tim said, which is that the administration is focused, or at least the president is focused on the interest costs on the debt. But here's the thing. The Fed cannot fix that problem. It can lower the short-term interest rate, but as Tim said, if it lowers the short-term interest rate and causes inflation, then the long-term interest rate goes up. And eventually, if they want to get inflation down, the short-term interest rate has to go up. So the Fed can't fix the interest problem that the federal government faces on the debt. The only way to fix that problem is to get serious about reducing the annual budget deficit. They just passed a budget for the next 10 years that actually increases the deficit. So I think there are a lot of market forces that are colliding, and I think they're going to be running right into Treasury yields over the next few months. I mean, I think the administration is going to try to get long-term yields down by issuing more in the short-term sector, but there's going to be a challenge there because, again, so much comes back to the inflation story. If they can't get inflation down, that's why I think this is about inflation. If they can't get inflation down, the Fed can't cut interest rates. And if it does cut interest rates, it's going to push inflation up. So there are a lot of forces that are colliding. I think it's going to end up pushing up long-term yields. And I think it's also going to end up causing a lot of friction inside the Fed. I'm concerned about the regional Fed banks next year because as soon as they start dissenting to interest rate cuts that they don't approve of, the political forces in Washington are going to start turning on those regional Fed bank presidents, asking why unelected officials in Chicago or San Francisco are getting in the way of the president's interest rate desires.
As Gus said, it could get ugly. Guys, thank you so much for your perspective. Great. Really interesting discussion. John and Gus, thank you. Tim's going to stick around. We got much more markets action coming up, including some trending tickers for you. You're watching Market Catalysts. 1 hour into the start of trading, let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Brooke DePalma is there for us today. Brooke, what are you seeing?
Good morning, Julie. All major indices in the red this morning, down just slightly as investors really digest three key things for this week. Those trade tensions picking up over the weekend as the Trump administration announced a 30% tariff on Mexico as well as Canada. And really, as Mohamed Al-Arian told Yahoo Finance this morning, is this just another escalation to ultimately de-escalate? Will these tariffs ultimately pass way through markets or ultimately come down as negotiations come underway? They're also evaluating that June consumer price index. We could get some key inflation data there when you look at the pass-through of tariffs and also that first wave of big bank earnings out on Tuesday and big tech out on Thursday with Netflix. The NASDAQ down just a bit after those record highs we saw in the last month. Also, the S&P 500 down just slightly. If you take a closer look, one thing that I'm keeping an eye on here is the cryptocurrency space. Of course, the Congress calling this crypto week. We're seeing Bitcoin hover above $120,000, or rather 120,000, hitting all-time record highs. We see Ethereum also coming in higher, up roughly more than 1% in early hours trading here, all off of this notion that there'll be some more regulatory or regulation coming out of Washington following this crypto week as three major bills are underway right now.
Yeah, we're definitely going to keep an eye on that. And I want to get to some of today's individual trending tickers as well. We're watching Autodesk, Becton Dickinson, and crypto-related stocks. First up, Autodesk no longer planning a potential acquisition of software provider PTC. That's according to Bloomberg. Shares of Autodesk trading higher this morning, up by about 4%. In a regulatory filing, Autodesk made no mention of a potential deal, which Bloomberg reported on earlier in July. The change comes after activist investor Starboard Investments has built a position in Autodesk with a focus on improving the company's margins. Brooke, as we look at this situation here, the reporting had sent the shares of PTC higher. Now we're seeing that go in the other direction here this morning.
Certainly what we're seeing here is really investors understand how exactly this came about. What was the major concern here was that this was going to be one of the biggest deals of the year, valued around $20 billion. And now what this company is really eyeing is more smaller, what they're calling tuck-in acquisitions. Also keep in mind, Autodesk has been a player here when it comes to that tariff concern, as companies really had to, work with their backlog in terms of construction rates. They also had a higher number of active users who are really using Autodesk in order to understand how exactly this was all going to play out as this tariff dynamic continues to change and evolve. They're constantly changing their business plans and trying to avoid those blind spots. But now as we see this sort of make way, what we know is that this will no longer be, say, the biggest M&A of the year, but rather Autodesk sort of focusing on those smaller players to really ramp up in this AI revolution, as Dan Ives likes to call it.
Yeah, and under that activist pressure, let's talk about a deal that does look like it's getting done, Brooke. Becton Dickinson's biosciences and diagnostic solutions business will combine with a subsidiary of Waters Corp. That deal worth about $17.5 billion. The company's confirming that one. Shareholders of Becton Dickinson are going to get 39% of the newly combined company. Waters shareholders will hold 61%, and the deal is expected to close in the first quarter of 2026. Now, it's interesting here that the shares, neither company is on the rise here today, Brooke.
What I think is also interesting is the fact that this is not just the first that we're seeing of a company sort of taking a small part of another company and bringing it into their portfolio. It seems like when investors think about this opportunity, it doesn't have them too excited. But what they're really touting here is that this will create a total adjustment market of about $40 billion. They said that the transaction is expected to be accretive to adjusted earnings per share in the first year post-closing. But ultimately, I think it's sort of a wait and see here as these synergies, as this small unit set to go into that larger umbrella is expected to really come to fruition in the year of 2030. And that's a while away for investors to certainly understand and really bake in this and how this could all play out. Also worth noting that the chief executive of BD will stay, as well as the CFO, and they're expected to stay within this new portfolio.
Yeah, I thought it was interesting. Leerink, an analyst over there, and Leerink kind of specializes in research on healthcare companies, said that basically that they don't think investors will view the deal attractively because of the dilution and also higher exposure to microbiology, which is happening as a result of this deal. So interesting there. And finally, I want to talk about cryptocurrency stocks because they are continuing to power higher. Bitcoin reaching over $122,000 during trade early Monday, even touching 123. Shares of Coinbase, Circle, Strategy, they're all trading higher as that rally powers on. And as we've been talking about, it's also the start of what Republicans are calling Crypto Week in Washington. The House set to debate several pieces of key crypto-related regulation over the course of the next several days, not just the so-called Genius Act on stablecoins, Brooke, that has been talked about here, but also digital asset market clarity, anti-CBDC surveillance state act. So that all going to be on the agenda.
Absolutely. And in a note, Oppenheimer is saying that these are some key things that investors have really been looking for. Rather, Oppenheimer analysts there have really been looking for in order to continue this momentum that we've seen behind companies like Coinbase as well as Circle, really looking at the passage of these bills. Also, Coinbase being well positioned to benefit from the ongoing adoption, which we expect more of because of the fact that we will have more regulatory clarity as a result of this so-called Crypto Week that's happening right now. This is sort of the momentum that analysts have really been waiting for in order to extend the rallies that we've seen in Bitcoin, as consumers, or investors rather, have really been looking to Bitcoin as this safe haven in this sort of environment. Also worth noting that another analyst had said that Coinbase is really positioned to benefit in this rapidly developing sector that we've seen over the past few years. In addition to that, it's worth noting that Circle has also benefited in this environment. They do have a minority stake in Coinbase, and Coinbase is really seen as what one analyst at Bernstein called the Amazon of crypto financial services. And so as that Crypto Week takes place in Washington, as this regulatory or regulations are undergoing and as they make way and as we hear more, we're seeing a bit of a rally here in those key crypto players as well.
Yes, definitely. Thanks, Brooke. Appreciate it. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Let's get more now on Bitcoin because we, of course, saw it hit that all-time high early Monday. The cryptocurrency flying past 120,000. Now it's hovering just under 121. So there's a lot of increasing number of ways for investors to invest in crypto. Let's talk about some of them. Tim Urbanowitz is still with me, Innovator Capital Management Chief Investment Strategist. And as it happens, you guys have an ETF. At least one ETF that offers exposure to Bitcoin, right?
We do, Julie. And you look at this whole conversation. We talked about the fiscal picture. Obviously, that is making the Bitcoin conversation even more relevant to our advisors as a store of value. But we take a step back and you look at this pocket of capital, the advisors that are talking to their clients about how do you own Bitcoin, institutions that are talking about how do you get Bitcoin in their portfolio. And their critiques historically have been, well, it doesn't generate income and it's too volatile. A lot of the developments that you have seen in the ETF market are helping to address those, and we think are really going to help open up this additional pocket of capital for crypto investing. So one strategy that we offer, QBF, what this strategy is designed to do is give you uncapped upside up to a 74% participation rate, while also limiting your losses to 20% over 3 months. So we look at something like that, really good way for advisors to have that conversation with their clients, knowing that you do have that floor against losses, really a good way to take down the volatility
Tim,
overall.
I'm really curious about this product, right? Because I've been doing this long enough that if something sounds too good to be true, it probably is. I'm just curious, how do you cap that downside when it comes to something like Bitcoin that's so volatile?
Well, so we use options. We do the whole defined outcome industry landscapes, all built on options. We're taking different payoffs that have been available in the structured note world for decades, bringing them into the ETF. So for advisors, it gives them the ability to work it into their model portfolios, different client accounts, very simply, very easily, without the need to go paperwork across 100 different accounts. So we're really excited when you think about these type of payoffs, not just on equities, which have exploded. The category is now at $70 billion in just defined outcome ETFs in the US. Which again didn't exist pre-2018, to bring that to an asset class like Bitcoin, I think is critical because again, so many advisors are trying to figure out, our clients are asking us about this, how do we get it into our portfolio without making sure if we go through another crypto winter, we're not blowing them up even with just a 2, 3, 4, 5% allocation.
What's the fee on a product like that look like?
79 basis points, and that's pretty typical for the defined outcome landscape. Innovators line up. We launched a lot of those strategies at 79. Which, if you look at this in the context of cheap beta ETFs, it looks expensive, but compared to the structured note world, you're cutting costs down significantly relative to what advisors used to have access to.
Gotcha. All right, thanks, Tim. I'm sure we're going to keep watching what's going on with Bitcoin. Appreciate it. Well, coming up, we got much more markets action. Stay tuned. You're watching Market Catalysts. Netflix second quarter earnings are due out Thursday, and joining us now, Yahoo Finance senior reporter Ali Canal, Brian Mulberry, Zacks Investment Management Client Portfolio Manager, and Tim Urbanowitz of Innovator Capital is still with us. Ali, so let's start with you. So what should we be looking for in those Netflix numbers?
Well, Wall Street is looking for a modest beat on both revenue and profit. Now, that's going to be helped by a weaker dollar, but it's really about the back half of the year that Wall Street analysts are focused on, particularly when it comes to content. We'll see the releases of Wednesday, Stranger Things. We just got their debut of Squid Game Season 3. And when it comes to Stranger Things, Netflix has been experimenting with eventized programming. So Stranger Things episodes, they're going to be released Thanksgiving, Christmas, New Year's. So really creating that community moment here, which Netflix has been looking to do. And it's not even just the programming and scripted content. It's also live events, whether it be NFL games or comedy specials. They're exploring a partnership with Spotify to potentially bring concerts to the platform. So content seems to be key for a company company like Netflix. And then when you look at the advertising picture, Netflix has 94 million ad-supported users on the platform. They also recently unveiled their in-house ad tech platform in the U.S. That has been rolled out and is continuing to roll out internationally as well. And management says it plans to double ad revenue this year to around $3 billion. So that's something that Wall Street's focused on. We will not be receiving subscriber numbers. That's no longer a factor in these earnings reports. So analysts are trying to look at other things to really give a sense of the health of this company. Really, that's been revenue, which Netflix has been aggressively ramping up. We did see price hikes earlier this year, so that's a TBD factor when it comes to how that could have affected subscriber numbers and churn. But overall, I mean, the valuation story is prime here too. Netflix shares are up around 40% since the start of the year. It currently trades at about 40 times forward earnings. That's a premium to the broader market and even some of its own tech peers. JP Morgan had a note out saying that a lot of optimism has already been baked into these levels, including upside to guidance, which is why they're sticking with a neutral target here, and they have a price target of $1,220 a share. So they see a bit of a deceleration heading into year end. But you're looking at that chart here, Julie, just so much momentum behind this name, especially within the broader tech space as well.
Yeah, and the shares trading very close to that record high of $13.39 here. Brian, I want to bring you into this. So the valuation issue that we just heard Ali talking about, is the stock worth it at these levels, given your outlook for it?
Yeah, it's a fair question. I mean, you're double basically the S&P 500 when it comes to that valuation. But when you look at the earnings growth rate, we have Netflix growing at roughly 21% in the EPS category over the next 3 years. That's triple what the S&P 500 is growing at. So in terms of that earnings growth, the valuation, I understand, is a little bit rich, but there's one of the few places that you're actually finding really strong earnings growth projected over the next 2 to 3 years.
And Tim, what about you? Is this something that you guys have in some of your ETF portfolios?
Well, Julie, a lot of those are broad-based, but when we take a step back and we look at Netflix, I think it's hard to get excited about it after the 28% rally that we saw since the last earnings report. And you look at the mega trend towards streaming. Obviously, they're in a great space, a growing space, which we think is very important. But their viewership, their overall percentage of market share that they have for U.S. TV viewership has remained pretty steady at that 7 to 8% level, even with this mega trend shift that we've seen towards streaming, which now makes up about 45% of TV viewership in the U.S. So when we look at that, we take a step back, talking about the valuation that Ali looked at, I think it's very hard for us to get excited about a name like this trading at that level.
Brian, at the same time, of course, they've turned to outside of the U.S. They've had some success there with international growth. And when you look at the streaming landscape, I mean, is there anybody else you'd rather own than Netflix, or do they still kind of stand out as that premium choice?
Yeah, I think they're absolutely a leader when it comes to providing this particular content. And I'm not saying that, Netflix has another 40% upside in the short term. I am saying that they are very competitive, though, in terms of growing, and they've made investments. They're going to spend $18 billion in content creation this year. It's $1 billion more than last year. And they've done it in a really smart way. I think the event-themed content that they're coming around, even when it comes to professional sports, they're not buying into streaming entire leagues or seasons. They're doing things around where they feel like they can have the most viewership. It's been very tactical. I think they've executed it very well, and it will continue to grow. Also on the international front, they've been partnering with telecoms to try and get that stable viewership through other means in terms of growing subscribers. So a little bit less worry for us on subscribers and eyeballs, because they've really done a good job at I think, kind of growing in organically with other means like telecoms and professional sports.
And Brian, now that we no longer have those key subscriber figures, what metric are you focused on here that really gives you a clue when it comes to the health of the business and its future?
Well, I think the best gauge is going to be that advertising growth. They want to double the ad revenue, as you stated earlier. Accomplishing that would only be driven by the fact that they're able to attract more viewers, that they could go back to advertisers and say, hey, look, we're gaining market share. We're getting eyeballs on screens like you would want to if you were an advertiser looking to place ads on the Netflix. So that's going to be, I think, the next most important metric in addition to overall earnings and revenue.
Hey guys, show of hands. Anyone see Superman this weekend? Nobody? How about the F1 movie? Did anybody see the F1? Okay, Allie saw the F1 movie. Oh, Brian saw the F1 movie. Because it's interesting, Allie, there's a couple developments here. It sounds like Superman did pretty well at the box office for Warner Brothers. They needed a win this weekend, right? And we also have some news about maybe Apple beefing up its relationship with F1, right?
Yeah, and I think for a company like Apple, it's smart. They are very strategic when it comes to their programming. If you look at the Apple TV Plus platform, they don't have a ton of content, but the content that they have is very thoughtful. They do have relationships with Major League Soccer, so we know that they're able to seamlessly integrate with a lot of those professional sports. And F1 has just taken on a life of its own. It really gained prominence with Drive to Survive that was on the Netflix platform. And now with the success of the F1 movie, Apple is thinking to itself, well, maybe that's something that we could double down on when it comes to the sports franchise, the fandom that's around F1. And then you were talking about WBD needing a win with Superman. And it is interesting because we had a bit of superhero fatigue over the last few years, but this is a refreshed version of Superman. It has a brand new cast. The lead actor is someone who's been around, but a bit underknown. And I think that's something that viewers have been craving. Just a fresh take. Huge for WBD, although analysts that I've been reading have said that they don't think that this is going to be super, super bullish for the company moving forward. They're actually a bit neutral on the impact here. So this company is one that's splitting up. It's going to be splitting their studios and streaming side from the linear network side. A win like Superman is obviously important, but there's still a lot more that we need to see from this company before Wall Street really piles in and gets on board.
Well, for the record, I've not seen Superman yet, but it is on my list. So for what it's worth. Allie, thank you so much. Brian, thank you so much. Tim, gonna stick around. Thanks, guys. We're talking tech coming up next. Stay tuned. You're watching Market Catalysts. One of the big earnings reports to watch this week, Taiwan Semiconductor due out on Thursday. Yahoo Finance senior tech editor Dan Howley joins us now for this. And we already got revenue numbers for the second quarter that topped estimates, Dan. So what are we looking for earnings?
Yeah, $32 billion in revenue for the quarter, up 39% roughly year over year. I think what we want to get more in depth on is obviously the sales numbers themselves, as well as what chips are doing well and which are not performing as well. The high-end chips from the 3 nanometer on around that area. Those are the super high-end chips. Those are what you're going to see going to the likes of NVIDIA or Apple. We want to see where if those are performing the best. And we're not going to get a breakdown as to which company saw the most revenue or generated the most revenue for TSMC. But obviously the big takeaway from it is likely going to be that AI is powering the majority of sales at this point. It'll be interesting to see what smartphone sales do, though, because we've been hearing kind of inklings of kind of slowdown in the market or not necessarily the growth that people were hoping for when it came to AI smartphones. So it'll be interesting to see what we can get from there.
And Tim Urbanowitz of Innovator ETFs is still with us. So Tim, when you're thinking about your semi exposure, tech exposure, more broadly AI exposure, what do you guys, how are you guys thinking about that strategically?
Well, Julie, we see it as a mega trend. We also see that trade as somewhat insulated from a lot of the macro headwinds there. And I think that goes back to what we talked about earlier with just being inelastic demand, very strong margins and pricing power. So we really like this trade. We think at least over the next 6 months, the infrastructure trade as a whole is still going to be in place. And then that trade we think will shift more towards those AI-enabled revenues, okay, and companies that are actually implementing AI, which right now, those numbers are still relatively small in terms of U.S. companies that are actually integrating it into their day-to-day business and benefiting from that. But we think that trend is going to change toward the end of the year, but still an area that we like in the portfolio, we want. And the inflation conversation that we talked about earlier, we think it also, because of that pricing power, really is a nice way to insulate portfolios from some of those macro headwinds.
And Dan, just quickly, Taiwan Semi usually does this kind of thing separately, but I'm curious if we will get any update on some of their manufacturing plans for the U.S.
Probably not, honestly. I think really they've kind of laid out what they're doing for the U.S. So far. They've committed to expanding some of their operations. This is all part of their kind of push to build more in the U.S. that other companies are doing on the back of not just President Trump's overall kind of push to get manufacturing here, but the CHIPS Act as well. They're a recipient of some of the CHIPS Act money, and so I think they're pretty set there. I think one of the interesting things to look for is if there was any pull in or pull forward of any revenue compared to the coming quarters, just based on tariff conversations, things along those lines. We saw some of that in the PC market, maybe in the smartphone market as well. Will that have an impact, or did it have an impact? I think that's something to look to see.
We will be watching it. Thanks, Dan. Appreciate it. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First off, we'll bring you the latest trade headlines from Washington and unpack the impact it has on your portfolio. Plus, should Tesla invest in Elon Musk's AI startup? That's the question Musk is posing to shareholders. Details to come. And Bitcoin's rally powers on as the digital currency tops $123,000. We'll discuss that and much more on Market Catalysts. It's now 90 minutes into the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets now. We are now turning mixed, but really little changed here today. That's even as over the weekend, President Trump now threatened new tariffs of 30% on the EU and on Mexico, 35% on Canada. But that said, the markets continue to shrug it off because those levies, if they go into effect, wouldn't happen until August 1st. We've got the Dow trading a little bit lower, as is the S&P. The Nasdaq is a little bit higher, and the bond market is also very little changed here today. We are awaiting CPI coming out tomorrow, and of course the continued discussions and conflict between the White House and the Federal Reserve is something very much on bond investors' minds as well. And we've got big bank earnings on deck. JP Morgan, Citi, Wells Fargo, they're set to kick off results. And joining us now, banking reporter David Hollerith, Tim Urbanowitz still with us, Innovator Capital Management Chief Investment Strategist. So David, let's start with you. What are the top things that we are watching for the banks?
Yeah, hey, Julie, I would say it's mainly whether or not the big six banks for over Tuesday and Wednesday, whether or not they update their full year guidance. Now, the story, obviously, of the beginning of the second quarter was that things started off pretty dismal for Wall Street, and progressively got better. We want to see if between what we know about tariffs at this point, or excuse me, what the banks know, along with the tax bill, what the second half of the year looks like. And just in general, because of the level of interest rates left unchanged, some of these banks could be posting or expecting higher profits, or net interest income over the year just because of that alone. So that's the first thing. The other thing too is just color on what to expect in the second half. And a lot of this goes back to the big pause we saw, not only for investment banking clients, but also just regular businesses that were trying to do plain vanilla loans. A lot of them stopped their plans in April, and we want to check in and see if companies are moving more towards business as usual, normalized territory, or whether or not there's a portion of those businesses that are still kind of holding on, staying on the sidelines. And then finally, we'll want to pay attention to the level and pace of buybacks. The big banks all passed stress tests at the end of June, and along with sort of a ramped up level of buybacks in the first quarter, we're going to want to see how many shares they bought back. That actually might be the story for them this week, is that even if profits are not going to stun, their EPS will be up compared to last year because of the pace they've been repurchasing their own stock.
And David, I want to ask about capital markets as well, right? All this year, we keep hearing, well, maybe now the capital markets are going to open. We're going to start to see more IPOs. Maybe now we're going to see more deals. And it's sort of happened, but it's been kind of a trickle. So what should we be looking for in that front?
Yeah, I mean, I think that we've seen some good IPOs, and then we've also seen a number of large merger transactions, especially around AI. So that kind of goes back to the pause question from April. I think what we'll be wanting to hear from the nation's top bankers is effectively, whether or not we're going to continue to see a fair amount of like specific large transactions in the market, or this is generally corporate America kind of looking for reasons to move. And in some ways, as we look to the second half of the year, that might actually be tariff driven. So I'm going to be paying attention to all those things.
Yeah, definitely. All right, Tim, let's bring you in on this and how you're thinking about financials and some of these issues that David has talked about. How do you think about what criteria you're looking for if you want to maybe invest in financials?
Julie, I think David hit on a lot of those. And when we take a step back and look at this earnings season as a whole, we think it's going to be pretty good for the big banks for a couple different reasons. One, you look at net interest income with interest rates staying higher. We think that's going to be a positive for banks. If we do see the Fed start to cut interest rates and long end goes higher, like we talked about earlier, we think that could be even more beneficial. And then we look at other pockets. I think trading revenue is probably going to come in strong. I know volatility has been down, but there's still a lot of uncertainty out there. A lot of clients trading around that. So we think that's strong. And then to David's point too, on the buybacks, we think that is going to be the area of focus this earnings season. Deregulation, a lot of the loosening of capital restrictions, I think really gives the banks the ability to pass back money to shareholders, which should be viewed pretty favorably.
Well, and Tim, let me just follow then on earnings more broadly as well, because over the course of the show, we've been talking a lot about tariffs. We've talked about inflation. We've talked about the Fed. We've talked less about earnings, actually, even though we're heading into earnings season. And I have read some commentary that perhaps the bar is low going into this season, whether it is for the banks or more broadly. What do you think?
We do. We think it's a low bar to clear. We think companies are going to deliver. They're going to do very well. We think the macroeconomic backdrop is very strong. It's very supportive. We look at things coming down the pipeline, specifically this big, beautiful bill that's going to put a lot of money back in consumers' pockets. Tax cuts on the corporate side should also help. So overall, we think the fundamentals of this market are very strong, and that's why we think equities can continue to do very well, and why we want more exposure to them in our portfolios.
What about the valuation question? I mean, I'm just pulled up a chart of JP Morgan. As David knows, it's done very well this year. It's trading near a record high. A lot of the other financials have also done well. And that's true of the broader market as well, where we're near record. So how much of that positive outlook is already priced in here?
Well, there is a lot of it priced in. I will say, that is one risk to this market overall. Is there's a lot of good news that is priced in. We think the market can very easily sustain this valuation, and earnings help really catch up here. But what we need to be thinking about, anytime you have a market that's trading in the range that we're in now, it doesn't leave much room at all for any bad news. And if you do have a bad news that starts to creep in, that bad news will magnify any downside that we see here. So yes, we want more equity exposure in our portfolio, but we need to be cautiously thinking about how do we get that in there. And obviously a lot of the clients that we're working with have very consistently been turning toward buffered ETF strategies to get that into their portfolio, where they have the known downside protection, but they do have the broad market exposure on the upside. With everything going on with valuations where they're at, the inflation story, we think that's very important to keep ramping up.
All right, Tim, thanks. You're going to stick around. David, thank you so much. I know you're going to have a very busy week. Appreciate it. Coming up, Elon Musk giving Tesla investors a big choice. We'll tell you what it is next. Elon Musk says Tesla shareholders will vote on whether or not to invest in XAI, saying on social media, if it was his decision, Tesla would have invested long ago in his startup, but he does not support a merger between the two companies. Joining me now, Yahoo Finance senior reporter Pras Subramanian, Tim Urbanowitz still with us, Innovator Capital Management Chief Investment Strategist. Pras, it's not too often, so I shouldn't say that. Musk does ask people's opinions sometimes about various things, but not necessarily when it comes to Tesla and sort of the direction and different decisions that are being made there.
Yeah, I guess, I mean, doing my research here, I remember last year he actually asked whether Tesla should invest in XAI.
Oh, and what did people say then?
Well, I think he kind of knows what he knows
doesn't want them to do it, and so that's maybe, I don't know.
It's almost like he knows what they're going to say on Tesla. He knows they're going to agree with him. It's like, should we invest in XAI? And then they say yes, of course. Well, so anyway, this was in response to a user asking. It's unfair that Tesla investors can't take part in XAI investment, right? As retail investors, and this comes after the weekend we're looking where SpaceX invested $2 billion a good amount of money into XAI. SpaceX being another Musk company. So it's this whole Muskonomy thing. They invest in one another, they get bought out by one another. Solar City is a very big prime example of that. And it all sort of, the Muskonomy working together in that regard. And you could say, well, hey, is there conflict here? Is Musk conflicted because he owns more of XAI than he does Tesla, et cetera, et cetera. So there's all that talk there. But he's talked about how I don't prefer that there's a full merger. Some analysts think that is the next phase, is potentially there would be a full merger of XAI with Tesla. But he's saying, no, I don't want that to happen.
Just from what exactly does XAI do at this point? Is it just Grok that they
Grok
have?
And we had the chatbot Grok with now Tesla in integration with the cars, right? So it's probably both an AGI type play, but also a supercomputing play, right? So that sort of makes sense that if there would be a lot of overlap there at Tesla, I imagine.
And actually, my producer just telling me that there's now a report now that XAI has launched Grok for government, that they have a contract with the U.S. Department of Defense. So that's the latest. Not that anybody said anything about conflict of interest anywhere, but he doesn't work in the government anymore. So, but yeah, so that's, I guess, part of the business as well. Tim, as somebody who has Tesla in the various portfolios, is this a good thing for investors? Is it agnostic? Like, what do you think?
It's a good question, and I think overall we look at Tesla. It's very hard for us to figure out that valuation, the 155 times earnings. I mean, we keep going back to that. Shareholders have not seemed to care for the last several years, so they may not start caring anytime soon. I think they have a great product. I own the product. It's a phenomenal product. But as an investment, I struggle to see, really how they get that monetization going. And if you look at the trends, Julie, I don't think the EV trends are necessarily favorable. They're not heading in the right direction. I think there's still a lot of headwinds to get over. You look at the charging networks, there's a lot of limitations. And even the inconvenience of having to go to those charging stations, spend 30 minutes to charge up your vehicle. I don't know that necessarily the broader adoption that everybody thought there was going to be with this whole EV revolution is going to be happening as quickly as once thought.
But of course, that's not why people buy Tesla, the stock, for the most part, right? They buy it for the robots and the robotaxis and the AI. I mean, Musk has even said that. So I guess the question is, if it does become more concretely an AI play, and not AI in the future of taxis, but XAI that actually does it today, does that change the sort of way that you think about it and invest in it?
Well, I think that's absolutely the way investors are thinking about it right now. I think the struggle is trying to figure out what does that end market actually look like in terms of the revenue that is going to be able to be generated across the board, and what does Tesla's market share look like? And that is a big question mark. So we take a step back, you look at what is being priced in right now. Could Tesla deliver? Absolutely. But at that valuation, there's a lot of risk that they have to start delivering on a lot of these things. And what we typically see with anything Musk or Tesla related, those things tend to take a little bit longer than originally advertised.
Right. I didn't realize he'd asked about that investment a year ago. So speaking of taking time.
Well, I forgot about that as well. But I will say this about XAI is that Bloomberg reported that the company burned through like $1 billion a month or something insane like that, right? So I could see how a Tesla investment or even Tesla merger could help in terms of defray some of those costs, use each other's assets in a more efficient manner. So maybe there is a benefit to that, but we're all sort of speculating at this point.
We are. Grok just got added to Teslas, didn't it, somehow?
Yeah. After its other controversies.
We'll leave that for another time. Thank you so much, Pras. And Tim, thank you so much for sitting in with me this morning.
Great to be with you, Julie.
Appreciate it.
Great to be with you.
Coming up, we'll get a check on today's biggest movers on the back of analyst calls. That's next on Trending Tickers. 2 hours now into the start of trading. Let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Brooke DePalma here with us. So things sort of moving around in a very narrow range today, Brooke.
Yeah, moving around just a bit, really hovering that flat line as investors digest those new tariffs announced from President Trump at 30% on both Mexico as well as the EU. In addition to that, investors expecting key inflation data from that consumer price index from June. That's going to come out before market open on Tuesday. And in addition to that, investors also trying to understand what earnings will look like as we hear from big banks out on Tuesday, and Netflix really kicks off big tech out Thursday. And so if you take a closer look, the Dow Jones Industrial up roughly just 0.9%, not even 0.09% there. NASDAQ moving a bit higher after we hit those record highs just a few weeks ago. If you take a closer look over the past about month, or rather year to date, we have really this rally that we've seen in the NASDAQ now, and we're really trying to hold on to that momentum here as we make way into today's trading session. Also, if you take a closer look, the S&P 500, also a major index to hit record highs, still trying to hold on to that momentum once again as investors digest those key three things. I also want to take a closer look at the NASDAQ this morning. A bit of a mixed picture here really coming into play. Apple seeing a bit of a downside here, down 1.3%, and that's largely because Citigroup came out with a note today saying that historically Apple does not do big mergers and acquisitions, but investors could turn a bit more positive if Apple could acquire or invest in a meaningful stake in an established AI provider. Once again, NVIDIA, that's been seeing a major moves year to date, roughly because of the fact that they're really leading this AI revolution. And if you take a closer look at the interactive here, Apple tailing behind there. Moving back intraday, I also want to point out Netflix. What we're seeing this morning in early hours trading is Netflix get a bit of a boost here from investors as they really get optimistic about what exactly this report could look like later on in the week. We know that if you take a closer look year to date, Netflix has this momentum behind it, and that's certainly moving higher today as investors really keep a closer look as that report's set to come out once again on Thursday.
Thanks, Brooke. Now stick around because we are going to talk trenders. Now here's a look at some of today's trending tickers. We're watching Lionsgate, Upstart, and Best Buy. First up, Lionsgate, that's the studio behind films like The Hunger Games, John Wick, and Twilight, could be a potential takeover target. Bloomberg News reporting that Legendary Entertainment is considering a takeover of the studio. Legendary is an independent film and TV studio behind the Dune trilogy and the Minecraft movie. Our Brooke DePalma is still with me. Lionsgate moving up a little bit today. This crossed sort of late in the session, almost at the end of the session on Friday. And it's interesting because Lionsgate had just separated from Starz relatively recently, and now you see this kind of report out there.
Absolutely. If you take a look year to date, Lionsgate is down more than 13%. But this momentum from Friday is certainly accelerating into today with shares down 6%. So what we really are trying to understand is what exactly this could look like. Also, with this new news out that Legendary is eyeing Lionsgate, other investors or other analysts on the street are saying that could this propose other players to take a closer look at Lionsgate as well? Could this potentially lead to other bids like we've seen in the past? One, to say and point out this entity, once again, as you noted, behind Dune. We know it's behind John Wick's, even behind Hunger Games. And so there's some known names. And I feel like now that the attention has been brought to the possibility under Lionsgate, that understanding of what exactly this could look like and who exactly could win out this bid is a bit unsteadying. We also know that Bloomberg intelligence analysts coming out saying that Legendary's exploration of a Lionsgate takeover is sensible, given that it's a pure play studio here, but perhaps investors really wanting more here.
And let's also talk about Upstart, Brooke, the online lending platform falling today after Goldman Sachs initiated coverage of the company with a sell rating. Analyst William Nance saying he sees limited progress on driving long-term consumer relationships. His price target set at $71. The share's down about 3% here today, and it's not the only analyst who's negative on this company.
Yeah, what we're seeing here is a stock that has really rallied over the course year to date, up more than 19%. Some things that analysts are really pointing out here is this concern about the company's limited progress in developing long-term consumer relationships. Also noting that the online personal loan market is competitive and indirect. And also there's this heavy reliance on cyclical third-party funding. And so what we're seeing here is, once again, that stock that has rallied year to date up 19%. We're seeing a bit of a pullback as investors understand or really look out to see how much more room that has to run. Shares down 4% over the past 5 days and down just 3% today alone.
Yes. And then in your neck of the woods, Best Buy getting a downgrade over a Piper Sandler from overweight to neutral. The analysts there saying the company lacks any meaningful catalysts in the coming quarters. It's also facing competition concerns. Those shares down 3% also, Brooke.
Yeah, Best Buy has really been under pressure. If you take a closer look year to date, we've seen this company really struggle as President Trump's tariffs have gone into effect. Year to date, shares are down nearly 19%. And what we've heard from Best Buy CEO Corey Barry in the past is that they have to have consumers willing to spend on that new technology like computers and tablets that really maybe have that new AI technology. Best Buy has really bet on that, banking on consumers really wanting and willing to splurge and spend. But as we've seen here, consumers are really looking where they can buy the best deal. Are they going other places like a Walmart or an Amazon, especially over the course of this past month during those key deal weeks in order to get that savings? And ultimately, what exactly are they waiting for here? Are they really going to splurge and spend on that new AI technology like Best Buy has been banking on? Of course, it'll be interesting to see how that Nintendo Switch did over the past quarter as well in their upcoming report.
Brooke, thank you very much. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. President Trump now threatening 100% secondary tariffs on Russia during a meeting with NATO Secretary General in the Oval Office on Monday. He has still been speaking about the conflict between Russia and Ukraine, and it is there that he made those comments, floating this idea of 100% secondary tariffs. Now, oil, which was hovering near a 3-week high at the start of the session, has since retreated to the lows of the day. With more on what Trump's remarks mean for the energy and oil markets, Fernando Valle is with us, Hedgeye Risk Management energy analyst. Fernando, so how would this change the dynamic in the oil markets, if indeed, and we know that not all of the tariffs that President Trump floats come to pass, but what kind of implications would this have?
Yeah, it will be interesting to see if implemented. I don't think there's going to be significant effects. The folks that buy oil from Russia today already disregard the tariffs, let's call it, and they are being more aligned with it. Some are being more aligned with the U.S. post Iran, namely India and Pakistan, and some are our biggest rivals, namely China, who is the biggest importer of oil. So those tariffs will mean very little for a Chinese official that is already facing secondary sanctions in any regard. So it would just be a limitation for maybe India and Pakistan, but very small at the face of it.
And so you see this movement of oil lower, though. I mean, is that just sort of a knee-jerk reaction that doesn't reflect the actual fundamentals out there?
I think at the end of the day, it does reflect the fundamentals that we've been seeing, that essentially demand has been relatively weak on the gasoline side. And the one thing that Russia did export more that was more important than oil is diesel. And diesel, we have very limited ability to supply right now. So I think the fundamentals for oil are one of that is challenging because our peak demand usually is marked by the 4th of July holiday, which it's now past, and it was well below 2024 levels. And so those are the actual fundamentals. And I think that the oil prices moving lower here are just saying, hey, you might just hit demand even harder. The consumer may be all the more impacted. On the previous segment, you were talking about Best Buy and other consumer retailers. That's the same fundamental that's hitting oil here, in my view.
At the same time, you know, when oil comes down, that can also be a little bit of a tailwind for consumer spending, right? If they're spending less on gasoline, but on balance, beyond Russia tariffs, when we're talking about the tariff picture overall and kind of the uncertainty about where it's going to end up, from an economic perspective and then feeding into a demand perspective as well, how are you sort of factoring in the effect of the tariffs?
Well, we think tariffs are ultimately deflationary because it does reduce consumer spending. And so that leads to lower demand for energy, broadly speaking. And there are a lot of things happening at once, so it's hard to attribute just one factor. I'll point to Europe, for example, saying they'll spend more on defense as something that's bullish for overall energy demand. But for us in the US, the tariffs are overall would be detrimental to energy demand. Again, we can talk about delinquencies going up on auto. We can talk about delinquencies going up on student loans. All of that ultimately reverberates in energy consumption. And 2025 levels have so far been disappointing versus 2024. And I'll point again that the peak is usually 4th of July, and we're now past it. We saw fairly weak demand numbers for gasoline in the latest EIA report, which was last Wednesday. That reflected the 4th of July weekend already. And so we think that now going forward, it's a tougher environment for gasoline demand.
And Fernando, given all of this, why do you think that OPEC Plus has been willing to increase and keep up its production, reversing what it had been doing previously?
Yeah, it's a good question. I think there are two factors. One, they're bringing in countries that were outside of the quotas. They were producing over their quotas already. They're normalizing that. But the biggest one is in the summer, Saudi and UAE produce more but export less because of the power generation needs within the kingdom, within the Emirates. They raise their overall domestic consumption to deal with the heat. And so some of that unwinding is really not going to hit the export markets, at least not for a much longer period, because the domestic consumption is going to be higher. And then you're looking at on the US side, we've seen a drop in US drilling rigs. And so there's some potential for OPEC Plus to gain market share in the tail end of this year. But in the interim, they're really just bringing out the countries that were overproducing. They're now back within quota. And then for the large Middle Eastern countries, they increased their crude burn in the summer months. So the exports are not going to rise nearly as much as the quota suggests.
Fernando, thank you so much. Really appreciate it.
My pleasure.
Coming up, we'll hear from Mohammed El-Erian of Queen's College at Cambridge on how the president's trade war could affect the global economy. That's next on Market Catalysts. U.S. trading partners are readying a response to President Trump's recent barrage of tariff threats, including a potential 30% levies against the EU and Mexico announced over the weekend. In a piece for the publication Foreign Affairs, Queen's College Cambridge President Mohammed El-Erian wrote that the U.S. has, quote, shaken the very foundations of the global order, adding that there is no trusted conductor to guide countries and companies through the complicated transition to whatever's coming next. Joining me now is Mohammed El-Erian. Always a pleasure to talk to you, Mohammed, and thanks for being here, obviously in what continues to be a very tricky time here. So I guess I would ask first whether you think we are witnessing a sort of remaking of the global order. It seems like there have been so many fits and starts. It's difficult to get that big picture.
So I think that we are no longer in a world of uber globalization, where we're looking for ever closer integration of goods and people and flows. The question is, are we in a world in which there is managed globalization light or total fragmentation? That's the question mark. And we're not going to know this for another few years, I think, Julie.
And I thought the other thing that was very interesting that you wrote in your piece is that the U.S. is almost behaving like a developing nation rather than its sort of global dominant status. What do you mean by that, and what are the implications of that?
So we're seeing market correlations that normally are more common to developing countries than the US. For example, the currency weakens even though yields are going up. That shouldn't happen. The negative correlations between bonds and equities has broken down. So you're starting to see things and you're starting to hear narratives that are more common in developing countries than in the US. And I think that that's partially because the US is trying to remake its domestic system. There's a real question mark as to whether this is a Reagan moment in which the US changes things with a view to a better outcome, or is this a Jimmy Carter moment in which the US ends up in stagflation and ultimately recession?
Which do you think it is, Mohammed? Or if we don't yet know, how will we start to know?
So first, let me tell you, the market is all over the place on this. We started the year with an 80% probability that this was a Reagan moment. By the beginning of April, we were below 50%. And now we're somewhere around 70%. So we have fluctuated a lot. And that is unusual for the US with its mature institutions and big diversified economy. I think it's a 50-50. I don't think we know. I think it will depend on how other countries react as well. So it's a 50-50, but the marketplace right now seems more comfortable than I would be with where we're going.
Well, I wanted to ask you about that because what do you make of the extreme equity resilience here in the US in the face of all of this back and forth?
So I think there's two things going on. One has to do with the view that corporates aren't the sovereign, that you may have issues with the sovereign, but at the end of the day, US corporates are strong, good balance sheets, good innovations. That's one view. The other view is that people ultimately think that the US is escalating to de-escalate. That what we heard over the weekend against the European Union, against Mexico, is negotiation. And come August 1st, one of two things are going to happen. Either we're going to push the deadline out yet again, or the US will get what it wants from its trading partners. So the markets are pretty relaxed about this, more relaxed than I would be, but I understand that is the trade that has worked over and over again, and you don't want to get in the way of something that's been working.
Mohammed, as we and our viewers know, you are a longtime veteran, very well-known investor. What they may not know, you've also served on a number of corporate boards. You're currently on the board of Under Armour. So I'm not going to ask you specifically about those businesses, but I am going to ask you about that experience with these corporations and how they're tackling this current moment and how challenging or not, maybe, they're finding it.
So most CEOs I know will tell you that we are in a wait and see, Julie. We're waiting to see what is going to evolve. And that's important because it impacts your supply chains. It impacts how you think of where your markets are. So whereas the financial markets seem comfortable, what we're seeing on the CEO side is postponement of major investment plans, just waiting to see. It makes a huge difference whether the tariffs are 30% or 10%. It makes a huge difference whether the tariffs are volatile or whether they're going to be fixed. So companies are doing what most people would do is, you know what, I'm not going to commit multi-year investment funding until I know what landscape I'm operating in.
So the markets, of course, about this acronym TACO, right? Trump always chickens out, that the markets seem to have adapted to some extent. But when it comes to being a corporation, you can't really, I guess, bet on that kind of acronym, right? But I mean, do you think the markets ultimately were wrong about TACO, or do we still not know how that's going to play out?
So the markets were right in saying that the deadline will be pushed back and will be pushed back again. That's correct. What we don't know is ultimately what the destination is. So the journey has been consistent with a much longer time frame than what economists were afraid of. But we still don't know what the destination is going to look like. I'm hoping that we are going towards some sort of globalization light that is managed more, that the US feel that it's trading in a fairer trading system, that it no longer is responsible for so many public goods that are really expensive. That's what I'm hoping we're going towards. But we could just as well end up in a fragmented global economy. And for companies, what you're going to hear, for example, under Trump 1.0, we went from this notion that China can be your market, China can be where you have supply chains. Do you need C+1 or C+2? One or two other countries to increase your resilience. Now you hear C plus many, and some companies don't even want the C, they just want the many. And that means rewiring your supply chains. And that's not something that you do quickly. It takes time to do so, and it is expensive.
I'm glad you brought up China, because I know there is some strategists have speculated out there that part of the reason that the market hasn't reacted more to the tariff headlines is because they haven't involved China lately, right? Most of the focus has been elsewhere, and China is the big elephant in the room, so to speak. Do you think there's any truth to that? And what do you think we need to watch for when it comes to China headline risk?
So we know from Mexico, for example, that if you're not in focus today, it doesn't mean you're not going to be in focus tomorrow. I think Mexico was surprised over the weekend to hear about the possibility of a 30% tariff. They thought they had sorted that out. So I don't think China is out of the woods. I don't think anybody is out of the woods right now until we settle this tariff issue. But there's a broader issue with China, which is how quickly will it reform its economy. China right now is no longer a locomotive of global growth. In fact, the concern, and we saw the export numbers today, the concern is that China will start dumping its exports on other markets, especially the European Union, which will cause trade tensions there. So keep China on the radar screen. You cannot ignore it right now.
Mohammed, finally, quickly, since you mentioned the EU, the bloc says it's preparing a response, but it's willing to continue to negotiate. In the meantime, there's some reports that the EU might be looking to other countries to sort of form some alliances. What do you think of that? And do you think that the EU Europe generally, the stock market has been a good investment this year. Do you think that continues as a result of their positioning?
So I think the European financial markets are benefiting from the fact that the whole world was massively overweight the US starting this year. The US had outperformed other countries consistently. The US is where the major drivers of innovations are. And the US has a fiscal policy that's quite loose. So there was reason to invest in the US. During the year, what you've had is a realization that overweight is excessive. And that's why European markets have outperformed US markets so much in the first quarter by 17 percentage points, Julie, 17 percentage points. I think that for the outperformance of Europe to continue, Europe has to get its act together. It's one thing that having capital pushed out of the US back into Europe. What Europe really needs is to be able to pull back, attract the capital back. And it hasn't been doing enough for that as yet.
Very interesting stuff. Mohammed, always a pleasure to talk to you. Thank you so much. We really appreciate it.
Thanks for having me.
U.S. stocks keeping losses in check this morning, even after President Trump threatened higher tariffs on Mexico and the EU over the weekend. What is driving investors' resilience toward trade policy? Morgan Stanley's Mike Wilson has one theory, and joining me now to explain that theory is markets reporter Josh Schaefer. So, Wilson, always provocative. So what does he think's going on here?
Yeah, so this was an interesting analysis from Mike, because he sort of gave the caveat that perhaps there's some element of the quote-unquote taco trade, right, that Trump always chickens out. And that's sort of the prevailing take right now would be, well, Trump keeps escalating these tariffs and then dialing them back down. Maybe market just doesn't believe that we're going to be at these tariff rates, right? But he also sort of took a closer look, Julie, and you had a really interesting chart in here that had a little bit too much going on for me to pull up. So I'm going to give you the TLDR on it. But but he looked at different sectors that are exposed to different countries. And what his takeaway was really the tariff story should probably be all about China. So he looked at subsectors. 8 subsectors, including large ones like technology and semiconductors, would be heavily exposed to tariffs on China. Where they would not be nearly as exposed is tariffs on Mexico, tariffs on the European Union, and a lot of the other tariffs we've been hearing about over the last week. So Wilson's sort of arguing that for the market and the broad market, what would matter most is simply what the ultimate result is of the trade war with China, because those are going to be what impacts the big tech companies the most. And as we talk about seemingly all the time on this show, what matters to the market the most is likely what happens to big tech, right? And sort of what happens to those companies and how tariffs could impact them.
Yeah.
So maybe it's just a little bit more about China and not exactly what's going on.
So that implies then if we get more negative headlines on China, maybe that would have a larger, I guess that would be the test of his theory. If we get more negative headlines on China, would that have a more negative impact on the market? You know, we've also been hearing a lot of strategists talk about a couple of other threads. One is the reaction to the tax and spending bill, which on balance, actually, the positive reaction to it has been a little bit surprising to me, given that it's mostly just an extension of existing tax cuts. But there's also been talk about the depreciation. In other words, there is a measure in there that could lead to more spending on the part of companies and makes it more tax advantageous for them to do so. So there does also seem to be this view among strategists that it is more stimulative than had been expected and helps offset some of the cost of the tariffs.
For sure. You have A, the tax bill, and then B, I mean, we'll get more info on this over the next 3 weeks, right? But largely, strategists still feel pretty good about earnings too, right? Yes. You haven't seen clear enough impacts from tariffs for a lot of these strategists to just simply mark down their earnings estimates at this point. Again, we will certainly know a lot more over the next 4 weeks of whether they've been right to sort of be steadfast, but earnings revisions, after coming down significantly in April, have been coming up and sort of backing that part of the rally. And so when you add that into it, it's like, well, why do we talk about tariffs? We talk about tariffs because we're curious if they're eventually going to hurt corporate profits, right? And so right now, if our thesis is the current tariffs are not going to significantly impact broadly speaking corporate profits, then why would I be selling stocks? And so that's what the market believes, at least today. But maybe the data get worse and everything spirals, right?
Right, and it would pay to pay attention to those stocks where it would have more of a direct effect, which have seen more of a hit.
Yeah. Retail stocks still aren't doing well.
Right. All right. Thanks, Josh. Appreciate it. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.